El dato anterior era del 5,25%. Si miramos precisamente a los votos dentro del Comité de Política Monetaria del Banco de Inglaterra, ha habido 5 a favor de este recorte de tipos frente a los 2 que hubo en la reunión anterior. La votación en concreto del Comité de Política Monetaria del Banco de Inglaterra habla de hasta 4 personas, 4 miembros del comité, a favor de este recorte de tipos de 25 puntos básicos pendientes en los próximos minutos de la comparecencia por parte del Gobernador Bailey. Muestran precisamente los pronósticos del Banco de Inglaterra que el IPC dentro de 2 años será del 1,7%. Recorta la previsión del pasado mes de mayo, que estaba en torno al 1,9%. Dice que se basa en las tasas de interés del mercado. Recorte de tipos por parte del Banco de Inglaterra, que tampoco pilla por sorpresa a los mercados y además, eso sí, piensan que van a tener controlada la inflación dentro de 2 años. Apuntan a un 1,7%. El objetivo, por ejemplo, del Banco Central Europeo o de la Fed es del 2%, va un poquito más allá el Banco de Inglaterra. Enseguida lo analizamos, como siempre, con los mejores expertos, pero antes empezamos mirando a la actualidad, empezamos pendientes en este caso de Venezuela. Organizaciones internacionales en defensa de los derechos humanos han condenado los altos índices de represión y violencia en Venezuela y han exigido a las autoridades garantizar el derecho a la protesta y el respeto de los derechos de los venezolanos. Dice que son elementos esenciales en democracia. Las entidades firman un comunicado en el que muestran su preocupación por las detenciones arbitrarias y la criminalización de la protesta en un contexto preelectoral y postelectoral en Venezuela marcado por la represión y múltiples violaciones a los derechos humanos, incluyendo un grave patrón de detenciones por razones políticas, muertes potencialmente ilícitas, restricciones a la libertad de prensa y cortes de Internet. En este sentido, les alarma particularmente el señalamiento hostil del fiscal general venezolano Tarek William Saab a los detenidos en relación a la protesta y el anuncio de que se les imputarán delitos como instigación pública, obstrucción de vías públicas, instigación al odio, resistencia a la autoridad y, en los casos más graves, terrorismo, que les supondrán penas de cárcel. Pendientes de la represión en Venezuela, organizaciones de defensa de los derechos humanos condenan lo que sucede durante los últimos días. También la actualidad pasa en estos momentos por Irán, todos pendientes de las represalias por el asesinato en su propio suelo, el asesinato en Teherán del líder de Hamás. Los principales funcionarios iraníes se van a reunir en los próximos minutos, se van a reunir este mismo jueves con los representantes de los aliados regionales de Irán, de Líbano, Irak y Yemen para discutir posibles represalias contra Israel tras el asesinato del líder de Hamás en Teherán. Es lo que está apuntando la agencia Reuters según 5 fuentes. La región enfrenta, como saben, el peligro de un conflicto ampliado entre Israel, Irán y sus aliados después del asesinato de Ismail Haniyeh en Teherán el miércoles y la muerte del comandante superior de Hezbollah el martes en un ataque israelí en las afueras de la capital libanesa de Beirut. Ayer New York Times hablaba de que el propio Yamenei ha dado la orden para atacar directamente el suelo israelí. Se habla de un ataque combinado con misiles, con drones, donde podrían participar también las fuerzas proxies, los hutíes, Hezbollah. Ojo, porque Irán está reunido con sus aliados para discutir el ataque inminente contra Israel. Y pendientes precisamente de Hamás, les contamos que Khalid Mesal, considerado el nuevo líder de Hamás, se hizo conocido en todo el mundo en 1997 después de que agentes israelíes le inyectaran veneno en un fallido intento de asesinato en una calle frente a su oficina en Amán, en la capital jordana. El ataque contra una figura importante del grupo palestino ordenado por el primer ministro israelí, Benjamin Netanyahu, ha enfurecido tanto al entonces rey de Jordania, Hussein, que hablaba incluso de colgar los posibles asesinos y de desechar el tratado de paz de Jordania con Israel a menos que se entregara el antídoto. Israel lo hizo y también aceptó liberar al líder de Hamás, el jeque Ahmed Yassin, solo para asesinarlo 7 años después en Gaza. Pendientes del nuevo líder de Hamás, todo apunta a que Khalid Mesal será el que reemplace precisamente al propio Haniyeh. Mientras tanto, el embajador ruso en Israel, Anatoly Viktorov, ha dicho este jueves que cree que Estados Unidos fue informado sobre los planes y acciones de Israel en Irán, que resultaron en el asesinato del líder político de Hamás, Ismail Haniyeh. Dice que, dado el nivel de las relaciones bilaterales entre Estados Unidos y Israel, puede asumir que fueron informados hasta cierto punto y tal vez incluso involucrados de alguna manera. Es lo que apuntaba Viktorov al canal de noticias Rusia 24. Blinken en las últimas horas decía que desconocían estos planes por parte de Israel y que además no estaban involucrados. Además, el embajador ruso ha señalado que el asesinato de Haniyeh reducirá la opción de un acuerdo de alto el fuego y toma de rehenes entre Israel y Hamás, ya que el líder asesinado del grupo militante era una figura importante en las negociaciones. También destacó que la situación actual en Oriente Medio es peligrosa y extremadamente crítica. Y precisamente mirando a Rusia, el secretario de prensa del Kremlin, Dmitry Peskov, ha comentado este jueves que el envío de los cazas F-16 a Ucrania no cambiará significativamente la situación en el frente. En una rueda de prensa, Peskov ha respondido que los cazas serán derribados y destruidos y añadió que Rusia ya ha ofrecido recompensas a los soldados que derriben los F-16. Además, Peskov señaló que Rusia no tiene una confirmación oficial de la llegada de los aviones a Ucrania. Ayer la agencia Bloomberg hablaba de que los primeros cazas F-16 suministrados por la OTAN habían llegado ya a territorio ucraniano. Rusia, Dmitry Peskov, dice que esto no va a cambiar la situación en el frente. Pendientes también del análisis, como siempre, mirando la actualidad, pero en este caso miramos a los expertos después de la decisión de tipos por parte del Banco de Inglaterra, este recorte de 25 puntos básicos, también ayer la decisión por parte de la Reserva Federal, las palabras de Jerome Powell. Vamos a analizar estas cuestiones de la mano de Guillermo Santos Aramburu, socio de iCapital, asesores financieros y patrimoniales. ¿Qué tal, Guillermo? Muy buenas tardes.
¿Qué tal? ¿Cómo estáis? Muy buenas.
Muy bien, encantados de verte por aquí y también deseando conocer tu valoración sobre este recorte de tipos por parte del Banco de Inglaterra. Se preveía, más o menos, pero bueno, no estamos acostumbrados, ¿no? Estamos acostumbrados a subidas o incluso, sobre todo, a mantener los tipos. El Banco de Inglaterra parece que se moja después del Banco Central Europeo, a la espera todavía de la FED. De momento, el Banco de Inglaterra mueve ficha.
Era lo esperado y ha cumplido, vamos a decir, con el guión. Pensad que la inflación en Reino Unido, pues quizá se mueva entre las menores que tenemos en Europa y en los países desarrollados, incluido Estados Unidos, lógicamente, porque está en el entorno del 2%, es decir, cumpliendo el objetivo del Banco Central. Pero luego hay una serie de motivos que son bastante evidentes que de alguna manera obligan al Banco de Inglaterra a empezar a mover tipos con más, vamos a decir, fluidez, ¿no? Entre otras cosas que el país Reino Unido ha bordeado la recesión la parte primera de este año 24 y hay que inyectarle un poco de aire a efectos de que la economía tome un poquito de tracción, ¿no? Parece, conocíamos datos del mercado inmobiliario inglés y parece que son datos favorables, que el mercado inmobiliario va tomando impulso, encadena ya 3 trimestres consecutivos al alza y se recupera de la caída que sufrió el año pasado, en el 23, sobre todo fruto de las presiones inflacionistas y del endurecimiento de los costes de financiación experimentados el anterior ejercicio, cosa que, como decía, ahora no sucede y asimismo facilita pues esta bajada de tipos del Banco de Inglaterra, que será seguramente seguida de otras para evitar un mal superior, como puede ser que definitivamente la economía inglesa cayera en recesión, cosa que por supuesto no desea ni menos con el nuevo gobierno que acaba de llegar.
Empezamos, Guillermo, a conocer algunos datos precisamente de la votación del Comité de Política Monetaria del Banco de Inglaterra. Vemos que Peel, Green, Mann y Haskell han votado a favor de mantener las tasas sin cambios. Dicen además que existe incertidumbre sobre la interacción entre el recorte de la tasa bancaria y el ajuste cuantitativo. Hablan también sobre el PIB, el impacto del QT, que es mayor de lo esperado. Dice además que prevé una inflación del 1,7% en el tercer trimestre de 2026 y del 1,5% en 2027. Sabemos que el objetivo, pues por ejemplo, del Banco Central Europeo, de la Reserva Federal, es el 2%. El Banco de Inglaterra dice que en 2 años la inflación va a estar controlada hasta el punto de que vaticinan que estará en el 1,7%. ¿Cómo ves esta valoración por parte del Banco de Inglaterra? Justifican de alguna forma así este recorte, ¿no?
Eso te demuestra 2 cosas. La primera, que la debilidad de la economía europea, inglesa y la europea en general, porque Francia y Alemania siguen aletargadas en ese camino tan complicado que llevan trimestres y bueno, y no ayudan a la economía global de Europa, pero concretamente la británica pues está en una situación vamos a decir, de tránsito hacia la mejora. Ese tránsito hacia la mejora supone que los precios están bastante atemperados y moderados, y esos datos que citabas pues es la muestra de este débil crecimiento que está marcando la economía inglesa desde hace ya unos cuantos trimestres. Pero es que además, ya digo, hay grandes parámetros macroeconómicos británicos de la economía inglesa que no están ayudando. Vamos a conocer los costes laborales unitarios, hoy creo que se publican. Vamos a ver lo que suben, pero suben muy tímidamente. Es lo esperado, muestra de esa debilidad de la economía en sí en el Reino Unido. Y vamos a conocer también el ISM manufacturero, que lo conoceremos por la tarde, y vamos a ver lo que da. Pero bueno, si está por debajo de 50, indica todavía un entorno recesivo y tampoco ayuda. El mercado inmobiliario comentábamos que sí que está recuperando, pero todo muy lento. Entonces es una economía, ya digo, que necesita ese flujo de dinero que puede facilitar unos tipos más bajos, un mayor endeudamiento de familias y, por supuesto, de empresas, y el impulso, en definitiva, que unos tipos hacia abajo trae la confianza de empresarios, de consumidores, para que la economía del país pues vaya más. Y si va más, quizás esos datos de inflación que citabas no sean tan bajos, pues probablemente no serán tan bajos. Pero ahora mismo, con los datos que tenemos sobre la mesa, pues ese escenario bastante deflacionista es el esperado.
Bueno, pues pendientes del Banco de Inglaterra, quiero preguntarte también por la reunión de ayer de la Reserva Federal, las palabras de Jerome Powell, que parecía abrir la puerta a recortes en septiembre, que tampoco terminaba de mojarse, un poco en la línea de Christine Lagarde. Quiero preguntarte tanto por la decisión de la FED como por las palabras de Jerome Powell. ¿Qué te pareció lo más importante de su comparecencia?
Pues, aunque, como bien sabes, siempre hay que leer muy entre líneas, ¿no?, de lo que cuenta la Reserva Federal, pero parece que de una manera no definitiva, pero sí con cierta contundencia, incluso se acepta que el mercado inmobiliario, el mercado laboral, perdón, va perdiendo fuelle. Entonces, claro, no olvidemos que la economía americana, la Reserva Federal americana, el Banco Central allí, tiene un doble mandato, a diferencia del BCE de acá. El doble mandato es controlar los precios, pero, por otro lado, lograr el pleno empleo o el mínimo desempleo, ¿no? Entonces, claro, si se percibe un mercado laboral enfriándose, como ayer aceptaba y reconocía Powell, los datos de inflación parecen controlados, con algún pequeño salto, pero más bien controlados como se conocieron la semana pasada, el indicador ligado a consumo, que es muy seguido, ¿no?, por la propia Reserva Federal. Pues teniendo todo eso en cuenta, todo pues inclina hacia una primera bajada de tipos en septiembre, si no lo frena Donald Trump. Y porque ya sabéis que Trump se pronunció hace pocas semanas en un mensaje hacia Powell diciendo: mire usted, quizá no convendría bajar los tipos antes de las elecciones y dejarlo para después. Ya sabemos que la independencia de los bancos centrales en ningún sitio es total, ¿no? Veremos lo que finalmente sucede. Pero ya digo, fue un mensaje, como se suele denominar, más bien dovish, más bien suave por parte de Powell, reconociendo el enfriamiento que comentaba del mercado laboral, y que eso puede llevar a una primera bajada de tipos antes de lo esperado, que podría ser más bien en la última parte del año, sería en septiembre, y quizá en la última parte del año, en diciembre, una segunda bajada. Para mí es el escenario más plausible y probablemente, máxime, ya como tú comentabas, escuchando lo que dijo ayer, será el que vamos a tener después de agosto.
Bueno, pues pendientes de la Reserva Federal, quiero preguntarte también por las tecnológicas. Hoy, como comentábamos antes, estamos pendientes de resultados de Intel, de Amazon, de Apple, una semana de muchas turbulencias para el Nasdaq. Bueno, pues, prácticamente no para todas las bolsas. Ayer recuperaban tanto AMD como Nvidia, pendientes de los semiconductores, y hoy de estos resultados de grandes empresas. Quiero preguntarte qué esperas para la sesión de hoy, sobre todo de los resultados de estas grandes empresas.
Pues vamos a ver, porque esto está siendo un baile bastante agitado, con subidas y bajadas del 10-12% en una sesión de compañías tan gigantescas como es Nvidia, ¿no? La productora de chips, ¿no? Entonces es muy llamativo. Aquí hay dos fenómenos que van en paralelo, ¿no? Por un lado, la realidad de que hay vamos a decir, unos componentes en la vertebración del desarrollo económico y de lo que es la evolución del propio ser humano, basada en tecnología, basado en inteligencia artificial, que impulsa la producción de chips y la hace cada vez más necesaria y, atención, cada vez más sofisticada, y cada vez hay más barreras de entrada para nuevas compañías en este sector. Eso va por un lado. Pero por otro lado van las cotizaciones, ¿no? Que descuentan un escenario de incrementos de productividad por parte de muchas empresas, ya no solo del sector tecnológico, de multiplicidad de sectores, pues que quizá la inteligencia artificial tenga todavía mucho que demostrar a efectos de facilitar esos incrementos, esas mejoras en productividad. Lo juntas todo y salen que cuando se publican resultados y estos no son interpretados de manera favorable por el mercado, se producen fortísimas caídas. Y viceversa, ¿no? Como ayer pudimos presenciar con las publicaciones el rebote que se produjo, y también vamos a decir que, aparte del caso del fabricante AMD, las propias, en general, grandes compañías americanas que rebotaron con fuerza, desde Mastercard, pasando por otras, incluso más tradicionales, manufactureras, ¿no? De hecho, hoy los futuros del S&P se han levantado también en positivo, ¿no? Entonces, vamos a ver, es complicado. La ley de exportaciones americanas, que va a penalizar las relaciones comerciales con China, puede afectar mucho. El entorno no es nada sencillo. Los resultados que vamos a ir conociendo, pues vamos a verlos, porque cuando hablas además de multinacionales, como es el caso de Amazon, ya no depende solo de la evolución de la economía americana, depende de la evolución de la economía global. A poco que no reflejen lo esperado, vamos a ver caídas de mercado que pueden ser incluso fuertes por esta sensibilidad que describía, pero a poco también que sean especialmente positivos, pues vamos a ver determinados saltos en las cotizaciones. Yo lo que estimo es que este comienzo de verano, este mes de agosto, va a ser muy, vamos a decir, o va a estar con frecuentes saltos en las cotizaciones, con volatilidad por caídas, pero con recuperaciones fuertes, que va a haber ganadores y perdedores, porque, atención, desde mediados de julio más o menos el Nasdaq ha caído un 8 o un 9%, pero es que el índice de pequeñas compañías americanas ha subido en bolsa un 6, un 7, ¿no? Entonces va a haber ganadores y perdedores. Se trata de posicionarse en los primeros, sin olvidar a los segundos, porque esos saltos de volatilidad no van a ser ni mucho menos permanentes, ¿no? Y vamos a estar un poco al albur de esas publicaciones y de los mensajes de analistas y del nuevo presidente o presidenta de los Estados Unidos en cuanto a las relaciones finales con China. Lo que pasa es que ahí tanto uno como otra, en este caso, van a penalizar probablemente el comercio entre China y Estados Unidos, y en definitiva el comercio internacional, y en definitiva el comercio global, con lo que como mínimo cautela a este respecto.
Bueno, pues cautela también ante los datos que conoceremos en el día de hoy, al cierre de sesión, al cierre de campana. Muchísimas gracias, Guillermo, por estar con nosotros. Un placer.
A vosotros, hasta pronto.
Muy buen día, muchas gracias. Nosotros vamos a mirar ya la clave sostenible con JP Morgan.
JP Morgan Asset Management le ofrece la clave sostenible del día.
Será la...
Y les contamos que la Comisión Europea ha abierto expediente a todos los países de la Unión Europea por no cumplir con los objetivos de recolección y reciclaje de residuos. Les ha enviado cartas de emplazamiento, el primer paso del procedimiento de infracción comunitario. Los países tienen ahora 2 meses para responder y abordar los fallos detectados. La Comisión señala que todos los Estados miembros deben intensificar sus esfuerzos de implementación para cumplir con sus obligaciones.
JP Morgan Asset Management le ha ofrecido la clave sostenible del día.
Pendientes, como ven, de la actualidad económica, geopolítica, internacional. Una pausa y enseguida seguimos con toda la información en Negocios Televisión.
Silver Gold Patrimonio nace en 2018 con el objetivo de innovar en el mercado de los metales preciosos de inversión, ofreciendo nuevas alternativas para que cualquier persona, familia o empresa pueda entrar en el fantástico mundo de los metales de inversión de forma sencilla y acompañada por consultores expertos en el sector. Silver Gold Patrimonio quiere avanzar contigo.
Ven al Torreón, estamos en El Pardo, un espacio único en plena naturaleza. Disfruta de momentos de desconexión mientras saboreas la mejor gastronomía. Disponemos de 7 amplias terrazas y salones para todo tipo de eventos. Degusta nuestros exquisitos platos acompañados de una selecta bodega de vinos. A tu servicio, un gran parking y zona infantil. Abierto los 365 días del año. Cocina ininterrumpida desde las 10 de la mañana hasta las 12 de la noche. Haz tu reserva.
Pues ¿qué es un mercado financiero? Es exactamente igual que otro mercado. Como si vamos a comprar patatas al mercado, quien manda en los mercados financieros es la oferta y la demanda. Es decir, cuando nosotros queremos comprar algún título, alguna acción de alguna compañía, el precio vendrá determinado por el apetito inversor que hay de esa compañía. Haciéndolo muy fácil, si somos 10 los que queremos comprar 5 kilos de patatas, el precio subirá mucho. Si hay 50 kilos de patatas y queremos comprarlo tan solo 10, el precio bajará mucho, puesto que la oferta supera la demanda. En los mercados financieros sucede exactamente igual. Lo que pasa es que son mercados profesionales, donde no se puede ir a la bolsa de Madrid, de Nueva York o de Londres, como estamos ahora en las oficinas de Londres, a pedir, deme usted 5 acciones de esta compañía. Es un mercado profesional y necesitamos acceder a través de un intermediario. Por eso los brokers, que es exactamente lo que significa esa palabra en inglés, intermediario, permitimos el acceso de clientes, ya sean retail, corporativos, institucionales, a los mercados financieros.
Dos palabras que recuerdan lo peor de la economía financiera, la gran recesión, la crisis de las hipotecas basuras que se llevó por delante Lehman Brothers y que estuvo a punto de liquidar al sistema económico, ha hecho olvidar o al menos poner en un segundo plano episodios anteriores. Remontarse al 2 de diciembre de 2001 es remontarse a uno de los mayores escándalos de la historia económica. Ese día, la energética Enron se declaraba en quiebra. Primer distribuidor energético a nivel mundial, facturando 100.000 millones de dólares anuales, que de un momento para otro desaparecieron. La pregunta, ¿cómo algo tan enorme pudo llegar a esa situación? La respuesta, sencilla, era todo un engaño. La empresa, fundada en 1985 por Kenneth Lay, vivió un antes y un después con la llegada de Jeffrey Skilling. Uno de los mejores graduados en Harvard en su promoción del MBA, aterrizó en Enron en 1997, 12 años después de haberla fundado. Con él, la compañía descubrió, en toda su expresión, lo que es hablar de ingeniería contable, pasivos que se convirtieron en activos, préstamos que se computaban como ingresos, deuda maquillada, beneficios inflados. A ojos de la contabilidad, todo era perfecto. De hecho, era un ejemplo para los demás. La más innovadora, la menor manejada. Y lo fue poco a poco, hasta que la realidad fue saliendo a la luz. La junta directiva vivía engañada, con una acción en bolsa que cotizaba sobre los $90 en el 2000, pero que cuando las autoridades afloraron deudas escondidas y elementos ocultos fuera de balance, llegó a perder tanto valor, casi un 99%, que se cuantificaba la acción en apenas $1. Más de 10.000 millones de valor contable que se esfumaron de un día para otro, miles de ahorradores que perdieron su inversión. Acorralada, Enron se vio obligada a presentar el concurso de acreedores y en su día, la mayor bancarrota de la historia. Acumulaba unos activos de 64.000 millones, unas deudas de 30.000. 20.000 empleados perdieron su trabajo, consecuencia del desastre. Menos esperada fue la caída de su auditora, Arthur Andersen, una de las 5 gigantes del mundo en ese momento, que fue partícipe del engaño a la que le pedían los directivos que hiciera la vista gorda y que finalmente se vio arrastrada por todo el problema. A Jeffrey Skilling, la mente detrás de esta contabilidad, le salió mal su última jugada maestra. Antes de la quiebra se las vio venir, renunció a su cargo, alegando motivos familiares, vendió todas las acciones y 4 meses después la empresa estaba en bancarrota. Supuestamente él no sabía nada de la situación crítica de la empresa. En 2006 se lo condenó a 24 años de prisión, se le multó con 45 millones y entonces, ahí sí, él se convirtió en el mayor de sus críticos.
La historia de la bolsa española hay que buscarla más cerca de las leyes que de las acciones. De hecho, para buscar el origen del mercado bursátil en España, hay que remontarse al 10 de septiembre de 1831 con la publicación de la Ley de Creación de la Bolsa de Madrid. Sin embargo, el IBEX 35, el principal selectivo de la bolsa española e índice de referencia del mercado español, es mucho más joven y cuenta con poco más de 30 años de historia. Fue el 14 de enero de 1992 cuando el IBEX 35 vio la luz para servir de referencia al recién creado mercado de opciones y futuros. Desde entonces, la economía española ha triplicado su tamaño en términos de PIB, al tiempo que el valor de las empresas del indicador se ha multiplicado por 10. A lo largo de este tiempo, el IBEX 35 ha consolidado su posición como marca líder de la economía y de las empresas cotizadas españolas y principal indicador de su transformación. Desde su nacimiento, más de 60 compañías diferentes han pasado por la tabla. Para entender su composición y explicar la razón de sus integrantes, es importante señalar que el IBEX 35 es un índice ponderado por capitalización, lo que quiere decir que tienen más peso en las empresas de mayor valor, y lo componen los 35 valores más líquidos que cotizan en la bolsa española, ponderados por capitalización bursátil ajustada por capital flotante. Una composición que se revisa de manera trimestral. En estos años se ha convertido en el referente nacional e internacional del mercado de valores español y ha servido de subyacente para multitud de productos financieros. La representación sectorial ha variado también notablemente, lo que confirma al IBEX 35 como la principal referencia de los cambios en la estructura de la bolsa y la economía española a lo largo de estas 3 décadas. La estructura actual es más diversificada y en ella la digitalización y las energías renovables han ganado peso. Pero el IBEX 35 no camina en solitario, sino que se ve acompañado de una gran familia. Entre las incorporaciones más reseñables se cuenta en 2009 la llegada del IBEX 35 con dividendos. Este indicador incorpora los pagos de las compañías que forman parte del selectivo, un factor especialmente importante para el mercado español, en el que la retribución al accionista es una seña clara de identidad que le diferencia de otros mercados de su entorno. Desde 2021 cuenta con el IBEX Gender Equality para fomentar la igualdad de género, con un horizonte que no deja de crecer mirando a indicadores de sostenibilidad. Entre los últimos, IBEX ESG y el IBEX ESG Weighted, aplicando la metodología del operador suizo Six Group del que forma parte.
Has been exactly on our 2% target for 2 consecutive months. And inflationary pressures in the UK economy have eased much as expected. It was very nice to have music when I said, sorry about that. But this is very welcome news, as the music suggested. Now, at the same time, the UK economy has been stronger in recent months, and this is very welcome too. But it does add to the risk that inflation could be higher than we expected if we cut interest rates too much or too quickly. And despite easing, services price inflation and domestic inflationary pressures do remain elevated. So we need to make sure that inflation stays low. We need to put the period of high inflation firmly behind us, and we need to be careful not to cut rates too much or too quickly, all the while monitoring the evidence on how inflationary pressures are evolving. And the best and most sustainable contribution that monetary policy can make to growth and prosperity is to ensure low and stable inflation, and an economy where people can plan for the future with confidence and in which money holds its value. And we have truly come a long way in returning inflation to target. Chart 1, which just come up, shows the development of 12-month consumer price inflation since 2019, that's the white line. Inflation has fallen significantly from its peak. Over the past year alone, it's fallen from nearly 8% in June last year to 2% in the latest data for May and June. And we expect consumer price inflation to edge up again in the second half of the year, perhaps to around 2.75%. You can see that in the shaded area. But we then expect inflation to revert towards the 2% target over the next year. Now, under the surface, the decline in the headline number has been driven by lower goods price inflation, as reflected in negative contributions from energy prices, that's the orange bars, and fading contributions from food and other goods, that's purple and blue on the chart. As the effects of lower energy prices fade over the coming months, more of the headline inflation number will be driven by services price inflation, that's the yellow bars. So the stories behind the headline inflation numbers really only emerge as we dive deeper into price developments for goods and for services. The story on energy prices is worth repeating. After sharp rises following the start of the war in Ukraine, household energy prices fell significantly in the second half of last year, with large declines in the Ofgem price caps. These declines are currently pulling down on the annual measure of inflation. In the latest number for June, household energy price inflation was minus 27%. With a weight of 4% in the consumer price index, that currently subtracts about a percentage point from headline inflation. Now, as last year's declines drop out of the annual comparison over the rest of this year, this negative contribution from household energy prices will fade. And that's the main reason why we expect headline inflation to edge up in the coming months. As chart 2 shows, core goods price inflation has also fallen sharply over the past 2 years. That's the orange line. And we expect it to remain muted in the coming months. Again, that's shown in the shaded area. These are goods traded in international markets, and with supply chains restoring themselves and signs of deflation emerging in some key supplier countries, most notably China, global goods price inflation should help keep goods price inflation low for UK consumers. By comparison, services price inflation, that's the blue line, is declining more gradually. The continued strength in services inflation reflects more persistent inflationary pressures in the UK economy. So-called base effects from irregular falls in volatile components last year may even cause services inflation to rise slightly in August before we can expect it to ease again throughout the rest of the year. While goods price inflation has been a little lower than we expected in May, services price inflation has been somewhat higher. As chart 3 shows, these surprises have come with an uptick in monthly services price inflation rates, these are in orange, which can be indicative of momentum in price increases over the very near term. Now, much of that strength has been driven by an increase in the components of the services basket that are index linked or regulated, that's in blue, often resulting in price rises in the month of April. Monthly services price inflation, excluding these components, along with other volatile components such as airfares and hotels, have been lower. That's the purple line. And this may be a better guide to the direction for services inflation over coming months. But we need to watch this carefully. The Monetary Policy Committee continues to pay close attention to services inflation as an indicator of persistence in domestic inflationary pressures, along with a range of other economic indicators. But this does not mean that we should adjust our course with every data surprise that comes in. What matters for our policy decisions is the accumulation of evidence about the medium-term outlook for inflation. What the data add to our understanding of the underlying dynamics in the UK economy that ultimately determine the future path for consumer price inflation. And given the time it takes for monetary policy to have its full effect, we need to be forward-looking in determining how restrictive monetary policy should be to return inflation sustainably to the 2% target. A further factor in the MPC's assessment is the recent strength in economic activity. GDP growth has been noticeably stronger than expected over the first half of this year, following a period of weakness in the second half of last year. The committee sees it as most likely that underlying momentum has remained more steady and that the balance between demand and supply has remained stable. This judgment is supported by various indicators which suggest that capacity utilization and labour market tightness have moved by much less than the GDP numbers. The job of monetary policy is to squeeze the persistent element of inflation out of the system in a way that is consistent with returning inflation to target on a timely and sustained basis. That's what we did by increasing bank rate to 5.25% and keeping it at that level for a year. That has leaned heavily against second-round effects from global inflationary shocks on domestic inflation persistence. But we still face the question of whether the persistent element of inflation is on course to decline to a level consistent with inflation being on target on a sustained basis, and what it will take to make that happen. Is the decline of persistence now almost baked in as the global shocks that drove up inflation unwind? Or will it also require a period with economic slack in the UK economy? Or are we experiencing a more permanent change to wage and price setting, which would require monetary policy to remain tighter for longer? These have become important questions in the MPC's policy deliberations. As policymakers, we can have all three cases in our expectations with different weights attached to them, and those weights can change over time. The committee's collective modal or most likely projection of the UK economy is consistent with a relatively benign view of inflation persistence and what it takes from here to squeeze it out of the system and return inflation sustainably to target. As chart 4 shows, in this most likely projection, conditional on a market implied path for bank rate that declines to 3.5% over the 3-year forecast horizon, consumer price inflation falls back to 1.7% in 2 years' time and to 1.5% in 3 years. In this projection, second-round effects in domestic prices and wages are judged to take longer to unwind than they did to emerge, leading to some persistence in inflationary pressures. But against that, a margin of economic slack gradually builds over the forecast horizon, despite the recent pickup in economic growth. As such, the most likely projection encompasses the first two relatively benign cases that I just described. So the modal projection reflects the committee's collective judgment that we are making good progress in returning inflation to the 2% target sustainably. The progress has become clearly visible in measures of both inflation perceptions and inflation expectations. These are important determinants of consumer price inflation, given the role they play in wage and price setting in the economy. We should expect that perceptions of current inflation and expectations of future inflation will play into wage bargaining and price setting. Chart 5 gives a snapshot based on the bank's inflation attitudes survey of UK households and its decision maker panel survey of UK businesses. Short-term household inflation expectations, in purple on the left-hand panel, have continued to fall alongside the observed decline in consumer price inflation, while medium-term expectations in orange remain stable. Households' perceptions of the current rate of inflation remain elevated, that's the blue line, but they have fallen sharply and tend to react to headline inflation with a lag. Similarly, firms' current inflation perceptions and inflation expectations over the short and medium term have also fallen significantly. That's the right-hand panel. All of this points to a continuing normalization of wage and price setting dynamics, that the fall in headline inflation will feed through to inflation expectations and to weaker wage pay and price setting dynamics. So, even if we judge that second round effects will take longer to unwind than they did to emerge, the evidence from these indicators is consistent with the view that second round effects will continue to fade with the restrictive monetary policy stance that we have put in place and the emergence of a margin of slack in the economy. There is, however, an alternative account of the economy which is less benign than our most likely projection. And this account reflects a view that MPC members put some weight on too, albeit to different degrees, when reaching their conclusions on the appropriate degree of restrictiveness in monetary policy. This view is that the economy is closer to the third, least benign case that I set out earlier, that inflationary pressures have become more ingrained in the UK economy as a result of structural changes in product and labour markets, as a lasting legacy of the major shocks that we have experienced. One possibility that the committee has considered is that the rate of unemployment below which inflationary pressures begin to build may have gone up over recent years. There is also a risk that recent upside news to economic activity could reflect stronger demand relative to supply, in turn increasing inflationary pressures in the UK economy over the medium term. Now, we can think of the alternative view as a prototype economic scenario of the kind that Ben Bernanke has recommended in his recent review of our processes in times of high uncertainty. As we develop our response to Dr. Bernanke's recommendations, we will be in a position to articulate fully such scenarios. In the report we present today, giving some weight to an alternative, less benign view of inflation persistence is reflected in an upside risk or skew to our inflation forecast. The mean path for inflation is higher than the modal or most likely path as a result. Whether we think of the possibility of less benign developments in inflationary pressures as an alternative scenario or as an upside risk, the message is the same. We need to make sure that monetary policy is sufficiently restrictive for sufficiently long that inflation remains near the 2% target. Now, weighing the evidence at this meeting, the Monetary Policy Committee voted to cut bank rate by 0.25 percentage points to 5%. CPI inflation has fallen markedly over the past year back to the 2% target. The impact from past external shocks has abated, and the risks of persistently high inflation have moderated. So it's now appropriate to reduce the degree of restrictiveness a little to ensure that inflation remains sustainably around the 2% target. But key indicators of inflationary pressures remain elevated, and recent strength in economic activity has added to the risk of more persistent inflationary pressures. And this, of course, gives us pause for thought. Monetary policy will need to remain restrictive for sufficiently long until the risks to inflation remaining sustainably around the 2% target in the medium term have dissipated further. The committee continues to remain highly alert to the risks of inflation persistence and will decide the appropriate degree of monetary policy restrictiveness at each meeting. So with that, Claire, Dave and I will be happy to take questions.
Let's go to Faisal and then Ed, please.
Thanks, Governor. Faisal Islam, BBC News. Other central bank colleagues in Europe have suggested this phrase, one and done. It seems to me from the minutes that's not what you're saying, that the door is open for further rate cuts, just not necessarily loads of them. And does this delicate balance that you refer to, is it in any way interfered with or interrupted by above inflation public sector pay settlements?
Sorry, what was the last point?
Above inflation public sector pay settlements.
All right.
Yeah.
So on this point about, is it one and done or is it more to come? I want to just re-emphasize the language, partly the language I concluded with actually, about committee remaining highly alert to the risks of inflation persistence, and that we will decide, the appropriate degree of restrictiveness at each meeting. And also just point you to the final paragraph of the monetary policy statement that we've issued today, which essentially says a very similar thing, but it's frankly language that we've used for some time now, actually. So nothing's changed in that respect. I'm not giving you any view on the path of rates to come. I'm saying we will go from meeting to meeting, as we always do, and it's this judgment about resilience. Because if I can sort of ask myself a variant question, if you don't mind. I mean, if you said to me, what's changed? The answer is nothing's really changed actually much in terms of the economic news. It's that we have become more confident and over time of this path that we've observed for a while now, this path of the effect that the level of restriction is having and what it's doing. And we've become sufficiently confident now that we think we can reduce that degree of restrictiveness a bit, and we will go on making that judgment. So on the second part of your question, Faisal, on the news on public sector pay, a couple of things I'll say on that. First of all, the Treasury, obviously we have a Treasury representative who is in the committee. When we meet, we were very fully and properly briefed on it. A Chancellor and I spoke on it as well. Two things. First of all, we would take the lead in terms of pay indicators from the private sector, because the private sector pay is feeding through directly into CPI. But public sector pay obviously has an effect on demand, and it can have a signalling effect. On the whole, I think private sector pay tends to lead public sector pay, and that's what we've been seeing actually if you look in recent times. The second point I'll make is if you look at past behavior and you look at the incremental news, and this is a very simple back of the envelope thing. So, we'll get the full story with the budgets, obviously, because we haven't got the full story yet, because obviously we don't know how this is going to be funded. The Chancellor's got decisions to make on that front. There's a lot of analysis to do. The OBR is starting their process. And as you know, we condition our view of government policy on announced government policies, and that will come with the budget. But if you do a very simple back of the envelope on the increment to public sector pay that the Chancellor announced, I say increment because obviously there is an assumption already in there, going back to the budget earlier this year. The proverbial back of the envelope suggests an increment in inflation space, which is very small. I mean, you're in quite small second decimal place numbers at that point. So that's the back of the envelope. We'll get a much better story, obviously, by October the 30th when we get the budget.
Thank you. Governor, Ed Conway from Sky News. So you've just cut interest rates. It's a big moment. But one of the things you've mentioned a couple of times is that rates are still in restrictive territory. Yeah. So can you just expand on that a little bit more so that people understand? Does that mean that they are still likely to feel pain as a result of where interest rates, economic pain as a result of where interest rates are right now? And when can they expect that to change for it not to be in restrictive territory or for it to be not painful?
Well, we look at restrictiveness in terms of, I mean, you can look at it in a number of ways, but let's look at it in terms of where we think growth is relative to potential growth, for instance, in the economy. We obviously had a very small recession at the end of last year, a number of causes of that. We're coming out of that now. But as you see from our forecast for GDP, we've got growth, picking up. It's a little bit inconsistent year by year, and we've taken a rather sort of measured view, I would say, of the latest news in terms of how it feeds through. But I think that's a path of growth which suggests that we're still below potential, and we do have a small output gap opening up in the forecast. So I think that's one way of capturing the fact that there is still a restrictive setting in that sense, and we think that's appropriate given, I have to make this point again, having to ensure that the persistence of inflation is taken out of the system. So that's the way we look at it. We've talked about our style quite a lot in the neutral rate in these press conferences in the past. I think we don't provide it. We've never been in really of the view that we provide a quantitative number on what that is. But I think, as from things that we've published in the past, I think policy is above a neutral rate at this point, and we would see it gradually coming down as this degree of inflation persistence comes out. So there's a way to go still, and it's consistent with, I know you probably say, the message I kept giving during my introductory remarks, which is we've got to monitor this very carefully as to how, over what period of time and under what conditions we can start to release that. And I'm not giving any predictions on how that will work through.
Great. Can we go to Sam and then Sue, please?
Thanks. Sam Fleming from the Financial Times. Over the past year or so, the bank has been quite clear in the tests it's setting itself, in a sense, for gauging what policy should do. The focus has been on labour market conditions, wage growth and services price inflation. PAR 24 today slightly broadens this and talks more generally about persistence. Can you talk a little bit about why, in a sense, you're changing this language and what we should read into that? And second of all, you talked, again, per the previous questions, about not moving too quickly. In that context, do you think the market is getting ahead of itself and expecting another rate cut before the end of the year? Thanks.
Well, I'm not going to comment on the market curve because I, rarely do, actually. So the market will take a view, and I'm sure the market will be studying carefully what we've done and said today. So that's them. But I'll give a view. I'm sure Claire may want to come in on this. I mean, you rightly pick up that we've repositioned things today, and I'm really very keen that you sort of take that message away, actually. And the repositioning is this, and it's sort of, hopefully you saw it in the remarks that I just made, that the indicators are important, the data is obviously important, but we felt that at this point when we made this change in policy, it was appropriate to give something more of a framework within, describe the framework that we're looking at policy, which I would say really sits above then the data indicators. The data indicators obviously, if you like, are the evidence that supports the framework, but the data indicators are not the framework themselves. And so I go back to this sort of, trilogy that I set out about, what is this, what is the sort of what are the dynamics at the moment? Are we seeing, largely self-correction of these big global shocks, and that will feed through to then taking the persistence out? I think if you put all your chips on that slot, as it were, you would say, well, that's a pretty benign story then. That's a very good news story. The second intermediate case I set out was, well, actually, no, you take that, but you also need something of an output gap to open up. So it sort of goes back to Ed's question, actually, about restrictiveness. You can see that we have got an element of that in what we published today. And then the third one is rather different in a sense, but not inconsistent. As I said earlier, you can have all three in your weights, as it were. But the third one is saying, look, we've been through these huge shocks, particularly COVID. Has this caused structural changes in the economy, which we, of course, then have to take into account in the way we think about policy? Now, different members put different weights on these, but I'll hand over to Claire, who may want to develop this a bit.
Sure, thanks, Andrew. I mean, as you say, what we're doing here is we're looking at the accumulation of the evidence that we've seen over recent months, over the year, really, and thinking about how does data and the new data we get fit into that, and how does it fit into that overall picture relative to our expectation. So as the data evolves, and what we've seen recently is that it is evolving broadly in line with that expectation. That gives you more confidence that you're in this world where inflationary pressures are reducing. As Andrew says, we are also conscious of this risk that we might be in a sort of alternative world where you've got either stronger demand, more activity, or you've seen structural changes in the economy, post the shocks that we've had. And it's really about thinking about how do we think about those risks? How do we factor them into our policy making? I mean, this is one of the areas that Ben Bernanke really focused on in his report, which is, and we're putting quite a lot of thought into here, is how do we think about risks? How do we think about uncertainty? And how do we build that into policy making in a way that is sort of useful, thoughtful? And that's the work that we're undertaking now, thinking about, and you can see sort of here, sort of bringing that, doing some of that in what we've done today, and talking about this alternative approach, this framework that allows people to sort of think about that balance of risks. And as the evidence evolves, as we say, it gives us more certainty. We're in one world than the other, but of course there is uncertainty out there, and that's why we have to keep vigilant.
Hi, Sue Chan from The Telegraph. Just another one on public sector pay rises. Rishi Sunak has just tweeted that he is concerned that Labour's inflation, these are his words, inflation busting pay deals have put further Bank of England cuts at risk. Does your previous answer suggest that you disagree with that? And just another one on the minimum wage, if I may. There's a number of things that businesses are telling your agents on how they're coping with higher minimum wages, such as cutting hours and increasing non-pay benefits. Does that suggest that there's a sense among businesses that they are reaching the limits of what they can absorb on the minimum wage?
Well, let me take the two separate questions. Take the first one. I think, just go back to what I said before. I think it's now, the next step in this process now is obviously the budget on the 30th of October, because what we had this week was obviously a statement, but it needs to be sort of, in a sense, fully filled in, as the Chancellor said. Nothing different from what the Chancellor said there. And particularly, obviously, the question of funding and so on that goes with that. So we will wait for that news, and then we can fully process that, as we always do, as announced government policy, and see where it comes out. So that's the first one. On the national living wage, I mean, you're correct, and it's raised it's in our summary of our agents' forecast that, when I go around, I think when we all go around the country, I go around the country a lot. I mean, the national living wage does get raised quite a lot, and we spend quite a lot of time looking at it. I would say that actually, when we look at, if you go back to May, the May forecast, pay has actually evolved pretty much exactly as we thought it would back in May. We haven't had any surprises on that front. It's coming down. It's coming down, quite gradually, but it is coming down. So we've had no surprises on that front. So I think what I take from that is that the effects of the national living wage that we built in at that point have not, in a sense, been contradicted by bad news on the upside. We haven't seen that, frankly. We're obviously very vigilant on all that front, but we haven't seen any news that contradicted the view we took at that point. But look, we listen, and I listen, and I spend a lot of time going around the country, and I do listen to what our contacts tell us about that. And by the way, it's that both the national living wage itself, and it's this what they tend to call compression risk that you get, which is, of course, is that it does have an effect in a sense, above that, because otherwise differentials get compressed. It's a point that firms make very regularly to me. So it is it's a point they make, and we recognise and we factor into our thinking.
If I can just add to that, Andrew, I mean, it's absolutely the case that when we go around doing our agents' visits, we get that reporting back on the impact of the national living wage, and we flagged it, as Andrew was saying, very much as a risk at the time of the May forecast, because we didn't know how it was going to land. As we report in this report, for the reasons Andrew set out, we imagined it and estimated it would add about 0.3 percentage points to aggregate pay growth, and that looks to be. From what we can see so far, it has had what we're describing as a small impact so far on aggregate wage growth. So very much in line with expectations. So that's a risk that at least so far hasn't crystallized. We've incorporated it, and as Andrew stressed, we've seen wage growth very much following that projection that we had at the time of the May forecast. It's come down to 5.6% in the latest 3 months, and for private sector regular wages, and that was our forecast.
Let's go to Ashley and then Phil and then.
Hi, thank you. Ashley Armstrong from the Sun newspaper. Obviously, this rate cut is good news for borrowers and those with mortgages, but less good news for savers. What we found last time around when rates were rising was that the high street banks were very slow to pass on the benefits of the higher interest rates. Can you now sense who's going to benefit most? I mean, or in terms of, will the savers be hit quicker? Do you think that the banks are being faster to react to what the base rate is doing, or will it be kind of more benefit to the borrowers? And then if I could squeeze in one about, a lot of readers are kind of making big decisions about their lives and their homes and whether to remortgage. What would you tell them if they were trying to make a decision on whether to remortgage now or wait?
Well, we're rather careful as Bank of England not to give financial advice, actually, as you'll understand. What I would say is this. I mean, if you look at the pattern, if you look at the sort of path of mortgage rates, let me say a couple of things. I mean, they are actually now over 1% lower typically than they were this time last year. And I think what that tells us is that expectations of where inflation was going to go to have shifted. Inflation has come down, more rapidly than I think all of us feared this time last year, in terms of the global shocks wearing their way through, and that's obviously good news. Now, look at it more immediately. Mortgage rates have also come down, obviously less. Part of that fall I described over a year has actually happened in sort of recent weeks, actually. Now, of course, these days, with most mortgages being fixed rate over some period of time, they're actually essentially priced off the swap curve in financial markets. So they reflect obviously what financial markets think is going to happen to rates. And so you have seen some easing off in the last few weeks and a month or so. Now, we'll see obviously how markets react to the news today. I mean, that will be interesting, because you might say, well, markets, and that move I just described was in some sense sort of discounting what markets thought might happen. Because markets, if you look at pricing, have been essentially pricing a cut either today or in the September meeting. So, they had got that cut priced in. You look at savings. I've said this before. I would draw a distinction between term deposits and sight deposits. So term deposit rates have effectively followed mortgage rates. There may be timing differences. I mean, that can happen, obviously. But if you look at the last year, I think you find term deposit rates and mortgage rates have moved pretty similarly. Sight deposits have not moved as much, and that's true of the whole period of recent years, that the movement of term deposit rates has been larger than sight deposit rates. And I think I've certainly said in the Treasury Select Committee hearings before that one way of rationalizing that actually is to switch into the other side of our sort of activities of the regulatory side, that we now put a lot more, in a sense, and banks therefore put a lot more value on term deposits rather than sight deposits, because of the fact they don't run as quickly if they have a problem. And that's reflected in the regulatory liquidity structure and framework. And so banks do price them accordingly. I think we've been seeing some of that in recent years. Yeah. But for a period of time, so 3 months, 6 months, whatever, a year, whatever. Yeah.
And if I can, we put the usual chart in the NPR, chart 2.7 on page 38, that tells the story in the chart that Andrew's just told. Obviously, the other thing that was happening with sight deposits, instant access, is that, at the time when interest rates were very low, margins did really get squeezed. And so there was some rebuilding of margins. It's very important that rebuilding of margins shouldn't go too far, but it was necessary. And so, we'll certainly be tracking, as we always do, what happens to both sight and term deposit rates now that bank rate has been cut today.
Yeah, I don't want to spend my time promoting my own speeches, but the speech I gave at Loughborough University earlier this year goes through that point that Dave's just made in some probably grinding detail that you really don't want to read. But if you do...
Go ahead, Ben.
Philip Inman from The Guardian. You've got a prediction of lower growth and higher unemployment in the second year of the forecast. Can you explain to people why that's a price worth paying? And also, Dave, could you give us an explanation of, you've obviously voted at an earlier stage for a cut in rates. Is there a cost to not having moved earlier?
Well, let me start Philip, on the growth and unemployment point. And what I would say is this, that the path of unemployment that we now have in this report is a lot shallower than two things. One is paths we had in the past, two is history. And one thing I think quite notable thing that doesn't get said much is just how little unemployment has moved actually in the last few years. And that's a good thing. I mean, it's a very good thing. Now, there's a little bit of uncertainty, as we know, about exactly what the rate of unemployment is at the moment in this country with the problems with the labour force survey. But yeah, we use a lot of other indicators to track what we think it is, and it's somewhere in the lowish 4% range. If you look back in history, I mean, I'm not going to comment on how old you are. I'm old enough to remember when it was the headline in every newspaper and every news program. If you go back to the 70s and 80s, I mean, this is a very different cycle. So I don't want to see unemployment go up at any time, but this is it's a much shallower path. Why have we got that? Well, it really goes back to the sort of the 3 points, the three parts to the framework I said earlier. One is this sort of, in a sense, self-correcting path. The other is where restrictiveness does have some impact via an output gap, which does cause some, put some added weight onto the sort of onto the restrictiveness of monetary policy to get this persistent inflation point out. But it's a lot milder than we've seen historically, to be honest with you.
And all I'd add is look, the degree of restrictiveness that we've still got. I think everyone on the committee sees that as necessary to squeeze the persistent part of inflation to ensure that inflation stays sustainably at target. As I've said before, I said it in May when I did vote for a cut. Today is really about the collective position, so I'm not going to get into discussing those kind of issues today, but there'll be opportunities in the future to hear from individual members. Thanks.
We'll go to Joel and then Phil.
Joel Hills from ITV News. The MPC has been quite pessimistic on the potential growth rate of the economy relative to the OBR, relative to the IMF, and looking through the forecasts today, that seems to still be the case. Happily, we have a new government with the outline of a plan to kickstart growth. Are there things that the government can announce in the next few months that would cause the bank to be less pessimistic on the economy's medium-term prospects? And what view would the bank take of a Trump presidency? What impact would that likely have on the outlook for growth and inflation, please?
Well, I'll take those in reverse order. I'm sure Claire may want to come in on the first. I won't burden Claire with the second. We take no view on the potential of who will win the US presidential election. We will obviously be interested in the outcome, but we do not take a view on who's going to be the next president of the USA. Sorry. Well, we'll see who wins and what their policies are. We always condition our view on announced UK policies, let alone everybody else's policies. So we'll leave that there. I mean, on the question of growth, as I'm sure Claire wants to come in. First of all, we always condition on announced government policies. The government's obviously very new. It will formulate its views on what it wants the growth policies to be, and we will factor those into our thinking about the supply capacity of the economy. I will say I do agree very strongly, both with the current Chancellor and the previous Chancellor, because actually there's very little difference here, that there are important things that need to be done. Particularly in the financial sector, to encourage investment in the productive capacity of the economy. I'm very strong supporter of that. I was very strongly supporting Jeremy Hunt in that, and I will take the same view with Rachel Reeves. At which point I'll hand over to Claire.
Thanks, Andrew. It's we're not going to write the budget here, nor should we. I mean, clearly you're right. We've got growth, sort of underlying growth in our forecast at around 0.3% a quarter. So it isn't at the moment. We think that is obviously slightly lower than what we've seen in recent quarters. We think most of that was volatility rather than momentum. But in the medium term, we think if you look at what's in the data, including things like the business surveys, that's more consistent with where we're likely to go. I mean, obviously there's a set of things that could be done that can raise potential growth. Those are clearly things that would help with any sense around sort of inflation and output and that trade-off there. But we think what we've got in our forecast broadly in line with what the data is telling you and the underlying drivers of growth.
But just to underpin what Claire was just saying, and also what Andrew was just saying, the reason that it will be a focus of this government as the previous government is, as we set out each time in table the long table, table 1D, trend, labour productivity was 1.75% on average 98 to 07, and then it was 0.75% 2010 to 2019. So we've had that significant shortfall in productivity growth compared to history, and we've taken an assessment of where it's going to go in future. That hasn't changed since our last supply stock take. Overall, we had supply growth at 1.5% a year. We keep reassessing that depending on what happens in the economy. I mean, one thing that we focused on this time, and it's more in Andrew's third case, the case where there'd be more structural challenges, is that maybe the NERU, the medium-term equilibrium unemployment rate, could be a little bit higher than we've currently estimated. That in and of itself would actually be negative for supply growth. But as Andrew and Claire were implying, there are lots of things that could be positive for supply growth. But we're going to have to look at these things in the round, and we can do that with each time we come back and present a forecast in our supply stock takes, etc.
Phil, right there in the middle.
Thanks. Phil Aldrich at Bloomberg. Just looking at the inflation forecasts, they come down to below 2% at the 2-year and the 3-year horizon, which suggests that policy is too tight. So it implies that you either cut faster or further. I just wondered which is more likely. And it's great to see growth being upgraded in the short term. But the Prime Minister has said that he would like to see a 2.5% ambition, and I can't see any of that in the forecast. I just wondered what the probability of 2.5% might be.
Well, you quoted the modal inflation forecast. We also have a mean path for inflation, which, as I said in my introductory remarks, sort of starts to bring in this alternative scenario, to use Ben Bernanke's phraseology. The mean path is actually much nearer to target. So it goes back to this point I made about what weight you place on those paths in thinking about the stance of monetary policy going forward. So I think that's the way to look at that one. On longer term growth, I think we'll just come back to the point we were making earlier. Look, we always condition on announced government policies. At the moment, I would say, and this is essentially, Dave's just given you the figures actually, the potential growth rate is below the sort of historic trend of potential growth rates. Historic trend of potential growth rates more in the 2.5% range. It's below that, has been for a while. We will obviously very keenly follow what policies the government decides to adopt, and then put those through the process we use in assessing the supply side of the economy and the stock takes we do on that, and see where we come out. But it's too soon to do that.
Let's go to Jack and then.
Hi there, Jack Bonnet from The Times. Governor, you've outlined 2 scenarios where interest rates could be a bit higher, and obviously you've outlined all the risks around that as well. Just wondering whether or not you think it's reasonable for people watching this press conference and reading the report to think that we're going back to a world where interest rates are going to be much lower, i.e. are we going back to the world before the pandemic when we had rates near the zero bound? Well,
let me start by saying we're very clearly not going to sort of give you a sort of a quantified path of where interest rates are going to go. That will emerge. So I'll just make one point here, because I think it's important, because I get asked this question a lot. It's a reasonable question. Where are we going to? I think it's reasonable to say that it's unlikely that we are going back to the world we were in between 2009, actually post the financial crisis, and the point at which we started raising rates. And the reason for that is that world was really driven by very big shocks, if you think about it. So obviously the first driving shock was the global financial crisis, and then a number of others came along. Most recently, obviously COVID would be the one to point to there. And I say that not because I think what would take us back to that world? Well, I would deduce from history that what would have to take us back to that world is some very big shock that we don't know about at the moment. So it's much more likely, it seems to me, that we're going back to a world where, I was going back to Ed's question actually, where we will be somewhere around whatever the neutral rate turns out to be. which, let me say, it's reasonable to say is lower than we are at the moment because we're describing policy as restrictive, but it's higher than we were between 2009 and when we started raising rates, for the point I just made about external shocks.
Right in the middle there.
Hi, Yasha Popovic from Central Banking. In the report, it says that events in the Middle East have had a relatively... my apologies.
Yeah.
So Yasha Popovic, Central Banking. In the report, it says events in the Middle East have had a relatively little impact on inflation to date, and that there is a risk of intensification over a longer period. Given the events we've seen only just this weekend, does this assessment already need to be revised?
So it's a good question. I mean, I think, look, events in the Middle East are tragic, and it's terribly sad to watch it. It has had far fewer economic consequences than two sort of points of comparison. One is history. So if you go back to the 1970s, for instance, and secondly, therefore, actually, than I think many of us feared when these events started last October. And we can sort of speculate on why that is, but the easiest one to look at is the oil price. I mean, we've not had a big spike up in the oil price, which, I say, drawing on the lessons of history, it would have been perfectly reasonable to expect might have happened if you took a rather simplistic approach to the lessons of history. So that's encouraging, but I have, there's always a but. I think we have to be very vigilant on this front. I think, we decided that the risk, the skew that we had in the forecast, up till now, since those events started, we wouldn't retain because of the fact that we haven't seen the signs of it emerging. But I don't for a moment want to give you the impression that means we're not very vigilant about this, because, as you rightly said, things can change very quickly.
Chris, and then Andy, please.
Thank you. Chris Giles from the Financial Times. You say in the report that you don't want to go cut rates too much or too quickly. Can you define too much and too quickly, or is it just vibes?
No. Well, I'm not going to define it. I'm going to come back to the framework that we set out. I think we're going to have to, at each meeting, come back to this and say, and it's why, I played the point that in a sense, we've raised this assessment framework up a level from the evidence itself, but we're then going to ask ourselves, the question, what does the evidence that we've had since we last sort of considered it tell us about the framework? And what does it tell us about these sort of three parts of the framework? Are we seeing, more evidence that, this persistent inflation evidence, the fact that the second round effects, are taking longer to dissipate than inflation did to emerge. No great surprise about that based on history. But what are we learning about this? And that's what we'll do. So I'm not going to say, what is it? I'm not going to tell you what it means, because we don't know at this stage, I think, what it means. There are a number of potential paths here. Each member of the committee will give somewhat different weights to those three parts to the framework, and that's absolutely fair and understandable. Reasonable people can do that. And I would also be sure that each of us will, in a sense, recalibrate those as we see the evidence, and that's how we will do it.
Andy, right there.
Hi there, it's Andy Bruce from Reuters. I've got a question about quantitative tightening. In the NPR, it's mentioned that there's a degree of uncertainty about how QT will interact with rate cuts because it's never been tried before. And then it goes on to say if QT has a bigger impact than expected, then the level of bank rate allows some scope for it to be cut to counteract that if necessary. My question is, why wouldn't you just pause QT or reduce it in that situation and use bank rate, which is quite a kind of rough tool?
Well, I'm sure Dave will want to come in, but I feel sort of terrible about this, but I'm going to refer to another of my speeches. If you read the speech I gave at LSE a couple of months ago, the reason I say that, in that speech, I set out what I regard as an important point. There are two parts to the QT path, really. Because, by the way, we're moving to a system where the level of reserves, central bank reserves, will be demand-driven. It's a bit different from the Fed there, where they've more set a supply set sense framework, and they want to have ample reserves. Now, we can't tell you what that what the precise point where we hit that sort of demand number is. We're not there yet. We know that. But the reason I say that is that the first part of QT is to do with reducing the level of reserves to the sort of the equilibrium level, if you like. We think we may get there later next year, but we don't know for certain. The second part comes thereafter. That's not about the level of reserves. It's actually about a different issue, which is what is the right set of assets for the Bank of England to have on its balance sheet to match the equilibrium level of reserves. And that's really about where do we want the interest rate risk to be in that world? Do we want it should the central bank be bearing it, or should the market out there be bearing it? And you'll take a pretty big clue from what I said at the LSE that I'm more in favour of the latter than the former. Dave, what do you want to say?
Yeah, just to, I guess, try and locate the kind of immediate decision that we have to make. Andrew's talked more about the longer term considerations and where we could be going, but we'll make our decision for the next QT year in September. And that will be based, and this is what we set out in box A, where we've done our annual review of how QT is operating based on the last year, on 3 key principles. And those are, we've stressed these ever since we first set things out, actually 3 years ago. I think it was August 21. The first one is that bank rate's going to be the active tool. And we really do want QT to be in the background. We're not going to do QT if it risks disrupting the functioning of financial markets. And linked to that, we also want to take a gradual and predictable approach. So what we have put in for this year's box is the point you were quoting around, well, what happens now? It turns out that this meeting we have reduced bank rate. Where does that leave QT? Well, those principles still absolutely apply. And also, we've always been very clear that QT does have a small impact. We estimate it. If you look at, we've done just over, or we will have done by the time we complete this this year's QT, we'll have done just over 200 billion. Will have reduced the APF from 895 down by over 200 billion. That was the peak. And we think that our central estimate has had about a 0.1 impact on long-term interest rates. It could be as much as 0.2, but those are pretty small numbers, especially when you think about the context of where bank rate is now. And that comes back to this point about we're confident that QT can keep operating in the background for the next year, consistent with our principles. And given where bank rate now is, if there needs to be some kind of adjustment, we've got more than enough space to do that. But as I've said, our central estimate for the impact of QT through term premia is about 0.1. So, we've cut bank rate by 0.25 today. So that gives you a sense of the relative dimensions there.
Steve, and then Isha, please.
Thank you very much indeed. Steve Sedgwick, CNBC. Governor, I just want to follow up, actually, I think it was on Sam's question earlier on. You've conditioned all of us, you've conditioned the city to worry more about services inflation and average wage inflation, the twin bête noirs of the Bank of England. But you've changed your mind to cut on the basis of a very, very minor decline in both of those measures since your last decision. Are you telling the city, which CNBC and others represent here, that actually the city should turn down its algorithm's sensitivity to those twin measures? And secondly, former Bank of England economist, she was in the, I think, the structural economy department as well, Rachel Reeves, has just discovered a £20 billion plus black hole. Shock horror as well. Is the Bank of England as shocked as the former employee Rachel Reeves is about this huge black hole? And what are the ramifications of that?
Well, I think we leave fiscal policy to the government.
But it matters for the structural economy, doesn't it? If there's
Yeah,
a 20 billion hole all of a
I
sudden.
set out earlier, actually, I think it was Ed's question, how we think about that. I made the point that actually, we look primarily at private sector wages, and we think public sector wages play a role, but they're not the direct input into inflation measures. And I did say, you've got to, if you get the back of your envelope out, you've got to think about what the sort of the increment to public sector wages would be relative to what was expected, and then calibrate what you think the inflation impact of that will be. Well, now we'll know a lot more about that when we have the budget, but if you do a sort of rough back of the envelope calculation, it isn't that large actually. So that's the point. On services and wages, no, we're not sort of, this is not a sort of scrap this, look at this. It was putting it into a framework, which was my really point about Sam's question. It's a good question. Actually, as I said earlier, if you look at wages, actually, the path of wages since May, since we were sitting here 3 months ago, has been pretty much exactly what we thought it would be. Services inflation has been a bit higher, but other goods has been lower. And as I did mention in my opening remarks, you can spend a lot of time in the entrails of services inflation. Of course, that's our job, really. We can tentatively, I think, but only very tentatively say, look, some of the more sort of, if you like, sort of stable and less volatile elements look as if they're more stable and declining than some of the other elements. But look, we will get a lot more information before we're next here and respond accordingly. So no, I'm not in any sense sort of changing the message there, other than, as I said earlier, I think Sam's question again, we've very deliberately sort of put in place a sort of framework and to give you a good sense as to how we interpret it.
Isha over there. Yeah.
Thanks, Isha Nelson from the New York Times. I did want to go back to that new services inflation chart you showed that kind of separated out the indexed regulated part of inflation and other parts, and just kind of ask, is that in new information that you're showing us that there's a lot of it was indexed regulated components of inflation leading to higher services, suggests that you could look through that a bit more and then kind of focus on the other sections of inflation, of services inflation, that suggests it should be lower. I'm just kind of trying to understand better which bits you're looking at within it, but also make the argument that you can always slice the inflation data, the services inflation data, in ways that support a narrative. And we've kind of just been presented now with another one as a rate cut comes along. And just a tiny quick follow-up question for Claire, which is, now you're got your feet under the desk as Deputy Governor, what are the first priorities in terms of implementing the blanket review that you've kind of got into? Thank you.
Well, I'll start. You make a really good point, of course, that one of the dangers of our trade is that you slice things up so much that you lose the big picture. And we're very conscious of that, but you rightly raise that point. So hoping to avoid that, I think the point is some of the sort of what I call the sort of regulated or indexed services prices. I mean, we've all probably had our mobile phone bills and slightly gnashed our teeth at the sort of RPI plus element to it. Now, that, of course, is actually a sort of form of price indexation. So it has its own dynamic. And obviously, we should, given what's happened to inflation, headline inflation, obviously we should expect those index prices to adjust accordingly when they're next reset. So I think you do have to look at one set of services prices differently to others. There are others that are very volatile. We've observed, I mean, hotel prices are a good example. I think there's what's called now dynamic pricing goes on a lot, where they're adjusted much more frequently. And then there's a set of services that are sort of probably behaving more in a sort of way they've behaved for a long time. So I think it's sensible to look at all of those components, to look at them individually, but then you have to put the whole story back together again, because it would be unwise to obviously take decisions on interest rates based on one part of the story and not the others.
Thanks. Yeah. I mean, just actually on that point and on this sort of how we're interpreting data and thinking about it, I think it's important to distinguish between, has the data gone up or down? And did the data do what we expected it to do? Was it in line with what we thought? And that's quite important, because it's the second, if you like, that gives you more confidence of which sort of world you're in terms of is the economy evolving as we expected it to? And so I think that, you know, that's an important part of how we're thinking about this, not just the sort of direction of the data, but is it in line with what we would expect under the scenarios we're thinking about? On Bernanke, yeah, I mean, you know, getting my feet under the table and beginning to really get into the detail of some of this. I think there's a number of, I mean, there was a lot in that report, right? So it's a really big, it's a really sort of comprehensive report. There's a lot of recommendations that cut right across the way we think about and do monetary policy. A few things are clearly really important parts of that. One is this issue that we've touched on a lot today about how do we think about risk and uncertainty, and how do we sort of factor that into our processes around monetary policy making, and what's the best way to do that. There's a lot of complexity under these are really complicated issues, and it's, you know, there's a lot of complexity underneath the options of the different ways you can do that. There's related to clearly a set of issues around, you know, the role of the central forecast. I mean, we've talked about this a bit also today. Part of another thing that came out of Bernanke is this question about actually how do you think about supply shocks in particular, and how do you put that into this framework? I guess the final thing I would say is that a really big priority, and it's very clear coming in to this new, and it's probably the least glamorous bit, and so the bit you all might want to write about less, but actually some of the infrastructure we use for our technology. How do we think about data as new data comes in? How do we process that data? What suite of models are we using in thinking about the economy and modeling the economy and doing our forecasts? All those sorts of things. There's actually a huge amount in all of that. It's going to take quite a bit of time, I think, and for us to sort of progress those agendas. But, you know, there's an awful lot in it, and it's going to be quite a program of work over some time, I think.
We can squeeze in two more quick ones, so we'll go to Anna and then Francine.
Hi, thank you. Anna Wise here from Press Association. How much is the current level of interest rates still weighing on living standards, particularly now that inflation has returned to normal levels? And I just wondered how much you think today's cut is going to improve sentiment among households and businesses, or will there be some disappointment that they might not see mortgage pricing particularly come down immediately after this?
Well, I said earlier, I mean, in some ways, of course, because mortgages are priced off the curve, off the interest rate curve, you've already seen some movement in mortgage prices over recent weeks and months. So there's a bit of, you know, I think you have to be sort of, these days, you have to be sort of conscious that some pricing is an anticipation effect. Obviously, those are commercial decisions, but there's some anticipation effect going on there relative to what comes afterwards. So I think, you know, you have to sort of look at the whole range of things there. I'd really, on the level of interest rates, I'd go back to the point I made earlier. Yes, rates are still restrictive, and that's necessary to get the second round effects and the persistence of inflation out. So, you know, there will be obviously benefits to this. I mean, we are already, and we have been for a year or so. You know, household net income, real household net income growth has been positive for a year or so now, and of course that's because inflation has come down rapidly. So that is a benefit. Obviously, it stands against what happened before that, obviously. So as for what happens to confidence, we'll see.
Thank you so much. Francine from Bloomberg. Governor, you dropped the upside inflation skew in May. Now it's back. So what's changed? Are you pushing back against market exuberance, or is it really like an inflation change?
It's a different skew. So it goes back to the earlier question on we had a Middle East a Middle East skew in before. As I was saying earlier, we've taken that skew out for the reasons I gave earlier. But what we've now got is essentially a domestic risk in there. So they might look a bit the same, but they're not. The stories behind them are quite different.
And Jeff, last one.
Sorry, this is bad. Hello. Am I working here? Slightly bad-tempered question here. Are you at all concerned by the move in sterling at 8 o'clock this morning? Sterling did not wait for the announcement to move. It was 0.8%, 0.9% down. And the move, you know, it was a very clear buy the rumor, sell the fact move.
Well, I think a lot of things have been going on in the last 24 hours. So
there was no trigger at 8 except the nationwide, which
Sorry,
was
no.
above it. There was no trigger at 8 except the nationwide house prices, which were above expectations.
Well, there was a Federal Reserve decision last night. Actually.
Yeah, but it didn't. Yeah, but I mean,
there's a lot going on in the world economy. There was a Bank of Japan decision yesterday, so there's a lot going on in the world economy, and that's what affects exchange rates. So, so I wouldn't. I mean, look, I think what we've observed, Jeff, over the last few days, actually, is a slight shift in market anticipation of what the decision today would be. From, I think our market staff was saying it was 50-50 this time last week. It was about 60-40 by the time we sort of got to work this morning. Don't think there's any particular story behind that. I mean, markets will form their own views, and as I say, there's a lot going on in the rest of the world, so I wouldn't put anything more in it than that.
Thanks very much, everyone.
Thanks.